Alongside this more specialist series, which I'm doing specifically for business owners, I'm running a more general series about pensions, which is designed to demystify pensions a little bit. So you know that you need to get some of that hard-earned cash out of the company and into your personal portfolio. But where do you start? As I've mentioned previously, pension contributions are tax relieved up to a maximum amount of £60,000 or the full amount of your salary. It's worth noting here that the salary restriction doesn't apply in the case of a company making a contribution for an employee or director. As such, that means practically you can put £60,000 into your pension, provided that you aren't triggering the Tapered Annual Allowance rules. The good news is that the threshold is quite high now. As of the 24-25 tax year, the Tapered Pension Annual Allowance only applies once your income exceeds £200,000 and is then reduced by £1 for every £2 of your income rising above £260,000. The minimum your allowance can taper to is £10,000. So you've decided you're going to pay into a pension scheme to get funds out of the business. Where is this money going? There are a number of different types of pension plans which may be beneficial to you here, and understanding which one is right for you really comes down to your circumstances and what it is that you need. Many of you will no doubt have heard of SIPs and SSAS, on which I have done some other videos, and which I'll put a link in the comments. To keep it brief and without going into all the details, the main reason you would be thinking about having a SIP or a SSAS is in order to get a bit more control over what your pension can be invested in. For instance, in a full SIP or SSAS, you may be able to purchase the company premises in order to be essentially paying rent from your business into your own pension. For obvious reasons, these arrangements can be a lot more complicated, and it is important to get specific advice for your circumstances to understand whether it's something which could be beneficial to you. Even if you aren't at that point yet, it is important to bear in mind that pensions can be a really tax-efficient way of building your own personal security and making sure that you're getting those funds out of the company in a way which protects them from the company's success or failure. And it builds a bit of a base for when or if you need to step back. I hope that was useful. If you've got any questions, put them in the comments below, and be sure to check out the rest of this series on my channel. And also, please do like and subscribe. Thanks, see you next time.